Good afternoon, everyone. This is Christian with PerfectStockAlert.com, a 100% free service for smart investors and traders. All we ask in return, please refer a friend. Today we're going to be studying on Treasury stock. As I do in each one of these videos, I will show you the basic definition, and then we'll go on to look at real-life examples and expound on it. The beginning definition of Treasury stock is the portion of shares that a company keeps in their own treasury. Treasury stock may have come from a repurchase or a buyback from shareholders, or it may have never been issued to the public in the first place. These shares don't pay dividends, have no voting rights, and should not be included in shares outstanding calculations. A company can decide to hold onto Treasury stocks indefinitely, reissue them to the public, or even cancel them altogether. And in most cases, canceling them altogether is the best that can happen for an investor. Okay, the first question people are going to probably ask is, how do I find out whether or not my company is buying back their own shares? Have they been doing that, and so forth and so on? You can always look at the balance sheet for a particular company. We're going to start looking at the Bank of New York Mellon, and you can scroll on down here. I'm actually on Yahoo Finance, which you can get this information anywhere, Google Finance, your discount broker, so forth and so on. Scroll down to the bottom in the equities, shareholder equities section, and you will see, let me get out the tools right here, Treasury stock is listed right there, and you will see that it is a negative number on the balance sheet. Basically, this is negative for a particular reason. When it's negative, it's basically telling you that they have been buying back their own stock. In this case, when you're seeing a negative number, it's because the company took cash that they had on hand and they bought back their own stock, or they may have actually used the debt to do it as well, or a combination of both. But in effect, what they're doing when they do that is they're reducing the shares outstanding and ultimately giving shareholders more money, at least in the sense that your shares that you still hold now are worth more, and we'll explain that in a moment. But so you can see that the company has actually been buying back their shares for a while here, and that's good. We'd like to see that in certain cases. If a company is buying back their own shares, but those shares are excessively overvalued, then that's just a waste of your money that the company is mismanaging in effect. So you want to know if the company is buying back shares, are the shares in a good place where even you would be buying them at this point. And for Bank of New York Mellon, actually I already know that they are, so this is fine. I actually would like to see them buy back their own shares. Now, once they have those shares, they could do other things with them, and they could even screw up a good idea by doing stupid things with them. For example, they may later turn around and sell them for less than they paid for them. That would be kind of dumb, but they could do that. Another thing they could do is retire the shares altogether, or cancel the shares, which would mean they no longer exist. That would be an awesome deal, because then they couldn't screw the deal up. They went out there, they bought shares that were oversold and undervalued, and they made them non-existent. So now the improvement to your remaining shares is not going to be changed. Another thing they could do is turn around and pay their top managers or employees a bunch of stock options, and then they have to, whenever those employees call in those stock options, they have to give them stock. Well, that stock would come from Treasury stock. So just because they get a hold of really great valued stock doesn't necessarily mean that what they do with them next will be a great idea. So you really want to analyze what's really going on when they do this. In general, it's a good thing to see a company buying back their own stock, but again, it needs to be done properly. Otherwise, it's just a mismanagement. And a lot of things that people don't realize, when you buy back stock, you do in effect give yourself a better PE ratio and things like that, and the remaining shares are going to have higher earnings per share on each remaining share. However, just if that's the only reason a company is doing that, that's not really cool. That's not good management on their part. You always want to look at the company and what they're doing with the money. Is it the wisest choice, the best return on my money, and currently, not what it was a year ago, or whatever. You want to look out in the market and say, okay, is it better for the company to use this cash to buy back undervalued stock and I'll get that X return, or is it better that they invest into expanding one of their other operations that's going to be far more profitable? There's different things that a company can always do with money, and so you want to look at all the different scenarios that could be played out and ask yourself, is this what I would do with that money? It should be noted that Treasury stock can be used by the company to create extra cash should it be needed in the future. So just because stock gets reacquired and put back in the Treasury doesn't necessarily mean it will stay there. They can turn around if they need cash later and sell them back onto the market. That could work in their favor if they bought them at undervalued prices and sold them at overvalued prices. Another reason some companies maintain Treasury stock is to keep a controlling interest within the Treasury to help ward off hostile takeovers. Again, in general, an increase in Treasury stock can be a good thing because it indicates that the company thinks the shares are undervalued. By buying back its stock, a firm reduces the number of shares outstanding, which in turn gives each shareholder a larger piece of earnings. Likewise, a lower number of shares outstanding can improve EPS and other ratios. However, Treasury stock can also be abused. We've already kind of touched on that. One of the best examples I've ever seen of Treasury stock used was a story I heard about Warren Buffett. And in effect, what he did is he sitting with his company, he looked at the share price and he said, you know what, the company's shares are a bit overvalued there. And he wanted to sell them, but he knew if he turned around and he sold those shares that it would, raise a red flag for the whole market. People start selling his stock. So he didn't want to do that. So instead, he sees this undervalued company out there. It's got a lot of cash on its books, and he says, hey, I'll buy your company with all the stock, no cash involved, just a pure stock deal. And so the guy was like, oh, sure, it sounds like a great idea. So he turns around, he buys this entire company full of cash with overvalued Treasury stock. That was an ingenious move, and the market was none the wiser. Nobody freaked out, oh, he's selling his stock. In fact, he was, but no one saw it. Please take a moment to review our disclaimer. The information provided herein is our opinion only. Under no circumstances do any statements here represent a recommendation to buy or sell securities or make any kind of an investment. You are responsible for your own due diligence. To summarize, we do not provide investment advice, nor do we make any claims or promises that any information here will lead to a profit, loss, or any other result. These videos are for educational purposes only.